I'm Chris Davis, chairman of Davis Advisors, and we're having an investment forum today. And one of the most interesting things that came out of it was this discussion about how obsessed people are in focusing on expenses. And expenses are an important component of the investor return, but they pale in comparison to the importance of investor behavior. In other words, the timing of when investors decide to get into the market or into a particular fund, when they decide to get out, when they feel good, when they feel depressed, the timing of those decisions and their behavior reacting to that timing destroys far more value than a few basis points of expense one way or another. So for example, one of the most common causes of this investor behavior penalty is the fact that people feel good when prices are high and then want to get in. And they feel depressed when prices are low and then want to get out. Now another reason is that you get this behavior penalty is that people react to forecasts. All the time, people come up to me, even this morning, and ask questions about, is this a good time to get in the market? Is the market overdue for a correction? What about the outlook for interest rates, the political uncertainty? Well, what we know is there are many things that are important but can't be predicted in the short term. And reacting to these false forecasts destroys a lot of behavior. One investor said it best when he said, more money has been lost predicting corrections than in corrections. And I think the third reason that investor timing becomes such a penalty is that people imagine that when the market does go down, that it's some unprecedented calamity. You know, the data is that you could expect a 20% market correction every 2.5 years. That's been the average since 1928. So we know, of course, there'll be market corrections in the future. And yet, when they come, people tend to overreact. People tend to panic. So once again, they get in high when things feel safe, they get out low. And the destruction from that investor behavior penalty is really the most important determinant of an investor's return over time. And it's one of the reasons an investment advisor can be so valuable. I'm Chris Davis. Thank you for listening.